I recently received an email, well, it was really a marketing email, about a low-risk, high-reward trading strategy. Now, there's no question that the words low-risk, high-reward caught the eyes of more than a few people. You know, which trader doesn't want to get involved with low-risk trading coupled with a high reward? The problem is that low risk has a few meanings, and not knowing the difference can get your trading account in a whole heap of trouble. So we can say that in a low-risk trading setup, we enter a trade with a stop fixed as a low percentage of a trading account. The question then becomes, well, what is the high-risk percentage on a trade? For me, low risk translates to the amount risked on the trade and would depend on the setup that I'm using. An example would be a failure test of an important prior high or low on my trading time frame. Look at this chart here. The gray dotted line A represents a high off to the left of the chart that met my criteria for an important turning point. The green candle marked B indicates price breaching this level, and while buyers drove it higher, sellers stepped in strong to close well off the highs. The red candle C closes back inside, indicating a failure of this break. The entry candle D is simply showing the entry as soon as candle C closes, and the exit E marks the close of the trade at a structure point. Now this is a nice and clean trade entry. However, many times price will breach the high of the A candle where the stop is located. Price will then turn around, print another candle by giving another entry that plays out to target. This stop out and reverse is simply the same pattern playing out in a higher time frame. The expected stop out and reverse, it's accounted for, and the first trade is always entered at half of the usual position size. This makes it a low risk trade in comparison to other types of setups because the dollar's risk is less. But I doubt that is what is meant by the marketing emails. So from some of the material, the marketer was implying that the risk of taking a losing trade was low. Well, any method has a random distribution of wins and losses, so much so that a former trading mentor of mine, who has since retired from trading and just enjoys life now, said that he expected every single trade to fail. You can never know if your next trade is going to be a winner. If you could, with 100% accuracy, who wouldn't load up the boat? All we can know is that our setups have a positive expectancy, and we step up to the plate every time our setup presents itself. We want to take advantage of our expectancy and be involved in anything that fits our trading criteria. The marketing material also puts low-risk trading right alongside high-reward trading in the thought process. So I take it that you'll make multiple returns of your X risk per trade. Bold statement, but it's pretty common in many emails that cross my inbox hyping the next big trading system. So what is the trick for these low-risk trades? Number one, is it a consistent low percentage risk per trade? Number two, consistent percent risk and a tight stop. Now, I'm not privy to their trading course, so perhaps they suggest an extremely low fixed risk percentage of your trading account. A low risk percentage means a lower dollar amount lost, but also a lower dollar amount won. So if that's the case, then you certainly would need, depending on your account size, some serious moves in the market to give you a high dollar reward result. High dollar reward is relative to your expectations and available trading capital. For me though, what I would consider high reward may be much bigger or smaller than yours. So what if they suggest a 2% fixed risk and tight stops? This would certainly give you a good position size in relation to your account. However, if the stop is too tight, how many times do you get flushed out before the high reward trade actually kicks in? This can effectively drain your account through 1,000 cuts through commissions, not to mention slips and gaps. So perhaps the only way to get to the bottom of the LRHR trading that they promise is to ask them what they mean. And so I did. And I was told that the trades are high probability, so there's a low risk of not making money. While it wasn't worth going into random distributions, outlier events, the many variables that make up the risks in trading, or anything else with them. As a consumer who may be looking into trading as a part-time endeavor or even taking a serious run at it, be very cautious with these types of emails. They promise success, but they ignore the reality of trading. Number one, it's hard. Number two, it's very hard. Number three, it rewards very few. There is nothing low risk about trading. The best that you can do is start yourself off in your trading career under the right conditions. Premier Trader University may be just the trading program that you're looking for.